Okay, so now we can get started. Chapter 8, current liabilities. Now remember, we've heard that term before, right? What is a liability? A liability is a debt. It's something that needs to be repaid. It's something that we borrowed and have to pay for later. It's something that we owe to somebody. Usually it's cash, but we saw also that there's such a thing called deferred revenue. Remember that? Right. So we know, I think by now we should know what a liability is. And the word current means that it's something that has to happen within a year, which we differentiate from long term. Long term is something that we have more than a year to do, right? So if you look at these objectives, distinguish between current and long-term liabilities, well, we just did, right? Current, something, an obligation that needs to be satisfied. I like that term better. An obligation that needs to be satisfied within a year. And long term, we have more than a year. And sometimes we could have a liability that's a combination of both. For example, let's say you bought a new car and you took out a 5-year loan to pay it back. Now, when you first hear that, you think 5 years is long term, but you have to start making payments immediately. In fact, usually when you buy the car from a dealer, you make that first payment, right, the day you pick the car up. So you have to make payments every month. Those are the current liabilities. The first 12 payments that you have to make are a current liability, and then the remaining payments are long-term, right? So you could have a short-term loan, definitely. You can have a long-term loan, definitely. And then you can have one that's kind of a combination of both. The second topic here, account for notes payable and interest expense. We'll get into that. And account for employee and employer payroll taxes. We'll get into that. I don't think we're going to get into these topics down here. Contingencies. We might talk about one or two other liabilities in here. One that comes to mind is sales tax. So they use an example here of airlines when they talk about liabilities, because airlines borrow lots of money, right? They're known for that. And as a result, airlines usually are bad investments because they have so much debt. And if you have something happen to the economy like is happening right now, who's flying? Well, they still have to make payments on their loans, but if their revenue is off like it is now, they have lots of problems, right? And why do they have so much debt? Well, because these aircraft cost millions, even billions of dollars, and they borrow the money to buy them. Okay. So here we're going to talk about current and long-term liabilities. Liabilities have 3 essential characteristics, right? And this is definition from the accounting literature. That's where they get this from. Probable future sacrifices of economic benefits. Think about it. What do you pay your liabilities with? You pay them with cash, right? So here they're talking about a future. You buy something today, you pay for it next month. The payment next month is a future sacrifice of cash. When you see those words together, economic benefits, they're talking about assets. So which asset usually do you use to pay off your liabilities? You use cash. Arising from present obligations to other entities. Other entities, a third party, an outside company. You can't have a liability with yourself. I think that's the point. And present obligation means that it's something that has to be paid presently or in the near future, resulting from past transactions and events, right? So those are the three characteristics that all liabilities have, right? And then they explain that. And current versus long-term, current liabilities are payable within 1 year from the balance sheet date. Now they use this thing, they say 1 year or operating cycle. I don't like that term, operating cycle. So let's deal with the 1 year time frame. And here they're showing you a balance sheet from Southwest Airlines. Current liabilities, this is typical, right? Accounts payable, accrued liabilities. Now remember in chapter 3, I think it is, we learned how to make adjusting entries, and we saw that there were liabilities, accrued liabilities, things like salaries payable, interest payable, taxes payable. Right? That's what they did here. They just lumped them all together. Air traffic liability, I don't know what that means. I would have to read the balance sheet and look at the footnotes. But you can see it's a considerable number. That's $3 billion, right? And current maturities of long-term debt. Remember I said before that we have some liabilities that are partially current and partially long-term. The payments that have to be made within the next 12 months are here. Current maturity of long-term debt. So you took out a 5-year loan, but you have to make payments this year. That's what this represents. Okay. So now we're going to see the journal entries for notes payable and interest expense. And they make reference here to, in chapter 5, we saw notes receivable, right? And that this is the flip side of that. So what's a notes receivable to one company is notes payable to the other. Now think of a bank, for example. We go to the bank and borrow money, that's notes payable to us, but that's notes receivable to the bank. So it's a liability to us, but it's an asset to the bank. So when you borrow money from a bank, you're required to sign a piece of paper, right, called a note, where you promise to repay the amount plus interest. Here's an example here. Assume Southwest borrows $100,000 from Bank of America on September 1st, 2021, signing a 6-month note for the amount borrowed plus accrued interest due 6 months later on March 1st. What entry does Southwest make on September 1st, the day they borrowed the money? Debit cash, credit notes payable. Debit cash, credit notes payable. Now this money doesn't have to get paid back until March 1st. September 1st, 2021, March 1st is in 2022. Interest is accumulating on that note from the day you took out the loan. Now, you don't have to pay back the interest until March 1st next year. But what very important date is somewhere in the middle? right? September 1 versus March 1, what very important date in the life of an accountant is in the middle there? December 31st. December 31st, adjusting entry time. We will have to make a journal entry to record the interest that has accrued on that note from September 1st through December 31st, right? And that should be the next entry they show you. Now on December 31st, we have to record interest expense for 4 months. And you can count on your hand, right? September, October, November, December. 4 months from September 1st through December 31st. So what would the interest be for that period of time? $100,000 times 6%. And remember, whenever you see an interest rate in a problem, it's an annual rate. It's a 1-year rate. But we're not concerned with 1 year. We're concerned with 4 months here. So 100,000 times 6% would be $6,000. $6,000 times 4 over 12. 4 over 12 is 1/3. Right, so $6,000 divided by 3, or times 1/3, is $2,000. Debit interest expense, credit interest payable. Now, why interest expense? Well, interest is a cost of borrowing money, right? It compensates the bank for other uses that they might have had for that money. Plus they have costs, plus they have profit they want to make. So that's where that interest rate is kind of structured from. Why interest payable? Well, you haven't paid it. You owe it, but you haven't paid it. So look at the explanation they give you. Record interest expense, they should say, right? Record interest expense incurred but not paid. When you see the word incurred, by now, that word means expense. And when you see but not paid, that means liability, right? So again, go back to the very beginning of the semester when I told you that pay attention to what the words say. It tells you exactly what you have to do. Now, the next important date that we have here is March 1st, 2022. The money is going to have to be paid. The money is going to have to be repaid. The $100,000 plus the $6,000 of interest. Oh, actually, no, it's not 6,000. It's 3,000, isn't it? 100,000 times 6% for half a year is $3,000. Now, $3,000 of interest, we've already recorded $2,000 here. So that means that the interest expense that gets recorded in the next time period would be $1,000. So here we go. Here's the entry that we're going to make on March 1st. Now remember, think about what you're doing. You're paying back the $100,000 plus $3,000 of interest. So the debit to notes payable is always for the face value, the amount that was borrowed. Debit notes payable, why is it a debit? Because after you pay it, the liability goes away. Remember your basic debit and credit rules. Liabilities are increased with credits and they're decreased with debits, right? So that's a debit to notes payable. Credit cash for the whole thing. The whole thing meaning $100,000 you borrowed plus $3,000 of interest. Credit cash 103. Which means we're going to need debits of $3,000. Remember, the entry has to balance. We have a debit to interest payable of $2,000. That's the entry that we made here, this $2,000 credit to interest payable, now when we pay that money back, that's a debit. So now we have debits of 100 plus 2, 102, credits of 103. We need another debit of 1,000. That's the interest expense for 2022. 2 months, January and February, 2 months. So you could do the math, 100,000 times 6% times 2 over 12. Or you could just say to yourself, wait a minute, what does logic tell me? If $2,000 of interest was applied to 2021 and the total interest is $3,000, that means there's $1,000 that gets applied to 2022. And I like this little explanation they give you here. What does the entry on March 1st do? Removes the note payable recorded September 1. Removes the interest payable recorded December 31. Records the interest expense for January and February 2022. Reduces cash for the total amount paid, 103. All right, so this is a nice breakdown of what this entry actually accomplishes. Right, and here, look at this. This is a nice thing too. We record interest expense in the period in which we incur it rather than the period in which we pay it. Remember, what's the difference between cash basis and accrual basis? Accrual basis, we record the expenses in the period incurred. Cash basis, you record the expenses in the period paid. Well, we're on accrual basis. So we're going to record the interest expense in the period in which it was incurred. Now, it was a 6-month period in this example. 4 of those months was in 2021. How much interest expense gets recorded in 2021? 2 months was interest expense in 2022. How much are we going to record in 2022, right? The total was 3,000. 2,000 applied to 2021. 1,000 applied to 2022. Now, I'm not going to bother showing you this, but this is the other side of the transaction. This is what Bank of America would record, right? And I'm not going to bother with that because I don't want to confuse you, but if you're interested, right, here it is. You can take a look at it. All right, and then they walk you through another example. And again, you know, these things are worth looking at. I'm not going to go over it with you item for item, but again, it's the same kind of example. They borrowed the money on November 1st. They have to pay it back in 6 months. So November and December, 2 months in 2021 and 4 months in 2022, right? That's how you would go about doing that. Okay. Now, accounts payable, I think, you know, we've seen that all semester long. Accounts payable amounts the company owes to suppliers. Now, it's usually merchandise. A lot of retail companies, you know, they get the merchandise and they try to sell it first before they pay for it. So this way they're not using their own money and they don't have to borrow money to get inventory. But, right, amounts a company owes to suppliers of merchandise or services that it has bought on account or on credit. We've seen those terms used. The advantage to accounts payable is there's no interest, right? Notes payable, because the time period is longer and there's a time value to money. That's why we have to have interest on notes payable. Now let's take a look for homework. Exercise 8 2. All right, so this is very similar to what we just saw. On November 1st, 2021, Aviation Training Corp. borrows $60,000 cash from Community Savings and Loan. Aviation signs a 3-month 7% note payable. Interest is payable at maturity. Aviation's year end is December 31st. What do they want us to do? Record the note payable. Record the appropriate adjustment for the note on December 31st. In other words, accrue interest for how many months? 2, November and December. All right, and then pay back the note. So this is very similar to the example that we saw in the textbook, and also the other illustration that they gave us in the textbook, right? So if you can do those 2 things, if you can follow those 2 things, you should be able to follow this as well. So let me see. Do you all see this Excel worksheet? Can you see it? Is it visible to you?
Yeah.
Thank you. Okay. So this was exercise 8-2, which in the book is on page 425. And we're going to make journal entries. So we need date, account, titles, debit, credit, right? Okay. So the first date we have to worry about is November 1st. Record the note payable. So on November 1st, they borrowed $60,000 in cash, debit cash, credit notes payable. Great. All right, now the next date that's important is December 31st. Now on December 31st, I know I'm going to debit interest expense and credit interest payable. Right? I mean, I know I'm going to do that. But I don't know the numbers. I have to work the numbers out. So how do I calculate interest? It's principal times rate times time. So this is $60,000 I borrowed times 7% times 2 over 12. Okay. Now, I don't know. My experience tells me that what a lot of people do first is they do 2 over 12, and then they multiply that percentage times 60,000 times 7%, which isn't totally wrong, except 2 over 12 is not a nice number, right? It doesn't reduce nicely. It's one of those repeating decimals, right? So what I like to do whenever I can is if I take 60,000 times 0.07, that's $4,200. Right now, remember, $4,200 is how much interest would be for 1 year, 12 months. I don't need 12 months. I only need 2. Now, let me take the $4,200 and multiply it by 2, which gives you $8,400, and then divide that by 12. That comes out to a nice, round, even $700. So debit interest expense and credit interest payable, $700. If you reduce 2 over 12, you're going to get this weird number, which means you're going to wind up with a number that's close to 700, but it won't be exactly 700. And then when you go to put the numbers in Connect and it doesn't come out right, you're going to start getting upset and excited and blaming blaming Connect when it's really not Connect's fault, right? Right, just a little trick. I hate to say trick, but something that I've learned over the years, when I don't get a number that I'm comfortable with, I just look at it a different way. Now, the next date is in 2022, right? And that would be February 1st. So on February 1st, I'm going to pay the money that I borrowed back plus interest. Debit notes payable, 60,000. Now, what I like to do right away, because this is something I used to make a mistake when I was a student, and it used to drive me insane. I would know the interest expense, I would know the cash, I would know the notes payable, but I always forgot about that interest payable. I would forget about it because that was last year's problem, right? I'm not worried about last year, I'm worried about this year when I make this entry. However, right, we have to get rid of that $700. We have to get rid of that $700. So let me debit interest payable right now. Okay, now that's done. Now I have to debit interest expense. And how much interest, if this was a 3-month loan, and 2 of those months were in 2021, how many months are there in 2022? 1. Right, now here, this is where being lazy helps sometimes. If $700 is for 2 months, how much is 1? What's 700 divided by 2? It's $350. So you see, right? You don't have to always do the calculation. If you understand what it is that you're doing, right, you can find the number pretty easily. So what I'm going to say here was this was accrued in 2021, right? And here I'm going to say, now you don't have to put this in Connect, right? But I'm just putting it here so that you understand what it is that you're supposed to be doing. Applied to 2022, right? And now we're going to credit cash for the whole thing. So how much is 60,000 plus 700 plus 350? I think that's 61,050. Let me use my calculator because sometimes I make mistakes. $61,050. And if you wanted to do the math here, just to make sure that you were right, you would say this is 60,000 times 7% times 3 months out of 12, right? Now, 3 months out of 12 is 1/4, isn't it? So what's 60,000 times 7% divided by 4, or times 1/4? Right? Let me do that math again, just to make sure that I did it right. 60,000 times 0.07 is 4,200 times 1/4 divided by 4 is 1,050. Okay. So let's stand back. See the whole thing together. Right? There's the whole problem in one place. On November 1st, debit cash, credit notes payable. On December 31st, debit interest expense, credit interest payable, but for 2 months interest, November and December. February 1st, which is into next year, pay the money back. Pay the $60,000 back plus all the interest. Debit interest payable for the interest that was accrued in 2021. Debit interest expense for the interest expense that's incurred in 2022. Right, and you get a nice explanation of how to do that right back in the text. Okay, so that takes care of that. All right, any questions about that? I mean, I don't know. I mean, some people are totally freaked out every time they have to do a little arithmetic. But it's pretty simple arithmetic, I think. Any questions before we move on to the next topic? I'm going to take that as no. Okay, so let's go back to the text. Payroll liabilities. Now, I think everybody knows, because I guess at some point in your life you have worked, and you know when you get your paycheck, it's not the same as your gross pay, right? You have your gross pay, which is your hourly rate times how many hours you worked. And then you have your take-home pay, which is how much is left after all the taxes are taken out. And in addition to taxes, there are other things that can come out of your paycheck. A lot of people have to contribute to their health insurance. A lot of people have money put into some kind of a retirement plan, 401k or something like that. Sometimes employees have loans and they have the loans taken out of the paycheck and so forth, or you belong to a credit union and you have money taken out that's put into a savings account. I mean, there's a lot of different variations on this. Now, there are other entries involved. I mean, there's one entry that's your paycheck. Debit salaries expense for the gross amount, credit salaries payable or cash for the take-home pay, But then you have all these different amounts that are being taken out of your paycheck for Social Security tax, Medicare tax, federal tax, state tax. If you live in New York City tax, disability payments. You ever see that in your paycheck? Probably annoys you, right? Why are they taking this 60 cents out of my pay or whatever it is? These days now you have what? You have a lot of people have family leave taken out of their paychecks. You might have to contribute to your health insurance. That comes out of your paycheck, et cetera, right? So here we're giving you an example. Let's assume you're hired at $60,000 annual salary, which means your salary is $5,000 a month. And you realize that your paycheck is going to actually be less than $5,000 a month because you know all the taxes are going to come out. And when the things are taken out of your check, what do they call that? They call that withholding. Withholding. So you know that the employer is going to withhold federal and state tax, Social Security, Medicare tax, any kind of health insurance premiums that you have to pay, any investments to your retirement plans. So realistically then, your $5,000 a month salary comes down to, in this case, comes down to $3,150 in take-home pay, right? Very disappointing, right? So these are all the amounts that they took out. Federal tax, state tax, Social Security tax, health insurance, investments. So how do we translate that into a journal entry? Now, what we just saw, all those amounts that come out of your paycheck, those are what are called employee costs. Employee costs. There are also employer costs. So what are the employer costs? All right, and we'll see this when we get to the example where we have to make the entries. The employer has to pay, in addition to whatever you get paid, the employer has to pay the Social Security and Medicare taxes, the same amount that you paid. You mean it gets paid twice? Yes, it does. You pay it, and then the employer also pays it. So it gets paid twice. Unemployment taxes. You know, when people collect unemployment benefits, where does that money come from? Well, it comes from the state. The benefits usually come from the state. Where does the state get the money from? It taxes the employers. So there's a state unemployment tax and there's a federal unemployment tax. The federal unemployment tax is used to give money to the states when they run out of money. And we just went through this with COVID, right? That what was it, $600 a week the federal government paid? I got confused. One was $600 a week and the other one was $300 a week. One was federal, one was state. Now, a lot of times when states run out of money, they ask the federal government for help, but that money usually has to get paid back. I don't think that's what happened this time. I think because it affected so many people that they just, said, forget it. But the actual check comes from the state. It doesn't come from the federal government. Right. So here's an example. This is a company, Hawaiian Travel Agency, has a total payroll for the month of January of $100,000 for its 20 employees, right? This is everybody. not just one person or two people. This is the whole company, 20 employees. The salaries came out to $100,000. What amounts were taken out of the paycheck? Federal and state income tax, Social Security tax. Now here, they're giving you the rate. The Social Security tax is 7.65%. And the federal and state unemployment tax, 6.2%. Now we'll see how they handle that, because here it's combined, right? There is a federal rate that's separate from the state, but let's see if they handle it as one or they break it down into two. We'll see. Now, the employer contributes $10,000 to a retirement plan, and the employer contributes $5,000 for health insurance. Right, so how would you record that entry? Right, now remember, the first entry we're going to look at is the employee cost. This is what comes out of the employee's paychecks, the gross amount minus what comes out of the paychecks. Debit salaries expense for the gross amount, which was $100,000. Debit income tax payable for $24,000. That's the combination of the federal and state income tax that was withheld, right? Credit Social Security tax. Now they abbreviate Social Security. They call it FICA, F-I-C-A. That stands for the name of the law that was passed in the 1930s. You know, after the 1930s, that's when Social Security started, because we had a Great Depression and everybody lost all their money and everybody was broke. The banks all failed. There was no such thing as FDIC insurance back then. So in 1929, the stock market crashed, and anybody that had any money or pension or anything, they lost it. It all went away when everything crashed. And after that, the government passed laws so that people could continue to live. And one of those laws was Social Security. So this way, older, retired, or disabled people could get something because they had nothing. Everything they had was wiped out. So that's why the Social Security tax existed. And, you know, it's been changed over time. Healthcare was not a big thing in the 1930s, but it is a big thing now. So there was a major change to the law made, I think it was 1965. That's when Medicare and Medicaid were created. And Medicare applies to retired people, and Medicaid applies to people that, you know, qualify for this government benefit. Usually it's based on income. Here, they combined the Medicare and Social Security into one number. On your paycheck, you'll see it as two separate numbers, right? The Social Security is a bigger number and the Medicare is a smaller number. But here they combined it. And the combined rate is 7.65%, times 100,000 is $7,650. And now what's left over? If I take 100,000 debits and I subtract these two amounts credit, how much do I need to balance the extra entry? $68,350. That's the take-home pay. They don't credit cash, they credit salaries payable first. Eventually, you will debit salaries payable and credit cash, but they debit salaries payable first. Just an extra step. Now, this is one of the employer entries, right? This entry applies to the fringe benefits. Remember, if we go back to the beginning of the problem here, they told us that the health insurance is paid by the employer. The employees don't pay anything here. Nice company. The retirement plan is paid for by the employer. The employees don't pay anything. In this example, So we debit salaries expense for the total of the fringe benefits that the employer pays. So that's 5 and 10 is 15,000. Debit salaries expense for 15,000. Credit accounts payable for the health insurance. Credit accounts payable again for the retirement plan. Now, why don't they just debit a credit accounts payable once for 15,000? Look at it this way. You're going to have to write separate checks. You're going to write one check to Blue Cross for the health insurance, and you're going to write a second check to Fidelity for the retirement plan contributions. Right? So that's why they credit accounts payable twice, because eventually when you pay these things, you're going to write two separate checks. Now, the third entry is also employer-related cost, but it's the payroll taxes. It's the Social Security tax that the employer has to pay, plus the unemployment tax. Now, remember, I told you earlier that whatever is taken out of your paycheck for Social Security and Medicare is also being paid by the employer. Yes, it gets paid twice. You pay it once, the employer pays it again. In this case, it came out to $7,650. Credit Social Security tax payable. And I should say, why are we crediting liabilities for these things? Why don't we just credit cash? Well, because the amount is accrued first and then it's paid later, right? So this is another example of those accrued liabilities that we saw earlier when we looked at Southwest Airlines' balance sheet. So credit Social Security tax or FICA tax payable, $7,650. Credit unemployment tax payable, $6,200. Remember, the combination of the federal and state tax was 6.2%. 6.2% times 100,000 is $6,200. If I add those two amounts together, it adds up to $13,850. That is a debit to payroll tax expense. So when you make this entry, you debit payroll tax expense, but you don't really know that number yet. You have to figure out these two amounts first and then add them together. And that'll tell you what, when you add them together, that's the debit to payroll tax expense. And eventually what'll happen is what? Over time, you're going to debit the liabilities and credit cash. So on payday, the employees are going to get paid, debit salaries payable, credit cash. Sooner or later, usually it's once a month, you're going to pay these amounts to Blue Cross and Fidelity. Eventually, usually it's every quarter, the payroll taxes are paid, right? So they don't all get paid at the same time. We might pay the employees every week. We might pay the fringe benefits every month, and we might pay the payroll tax, other expenses every quarter. So that's why they're accrued first and then paid later. So if you think about it, what's the total cost of payroll for this company? What's the total cost? You only care about your paycheck, right? That's all you care about. But put yourself in the boss's seat. Put yourself in the employer's seat. How much are these employees really costing the employer? Well, I got to pay them salaries of 100,000. I got to give them fringe benefits of 15. That's 115. And then I got these extra costs here, which is almost another 15, right? So how much do these employees really cost me? They cost me close to $130,000. Not just the 100,000 in salary. That's all you care about, right? But if you're the boss, you're concerned about all of these things. Okay. So let's take a look now. We had another homework problem. Exercise 8. Exercise 8, which was on page 426. Okay, here we go. During January, Luxury Cruise Lines incurs employee salaries of $3 million. Withholdings in January are $229,500 for the employee portion of FICA, Social Security, $450,000 for federal income tax, $187,500 for state income tax, $30,000 for the employee portion of health insurance payable to Blue Cross Blue Shield. The company incurs an additional $186,000 for federal and state unemployment tax and $90,000 for the employer portion of health insurance. So we have 3 entries to make, right? Try to look at it that way. When you read through the problem, you're going to pick things out. You have 3 entries to make. The first entry is the employee entry. The employee entry, salaries, expense, withholdings, and salaries payable. All the amounts that are coming out of the employee's paycheck. That's the $3 million minus the Social Security, minus the federal tax, minus the state tax, minus the $30,000 that the employees are contributing to the health insurance. And then salaries payable for what's ever left. That's the first entry. The second entry, what are the fringe benefits that the employer is paying for? The employer is paying $90,000 for the health insurance. So the health insurance is a total of how much? 30 and 90 is 120. The employees are paying 30, the employer is paying 90. What entry are we going to make for that 90? And then finally, the payroll taxes. The payroll taxes are what? It's the unemployment taxes and the Social Security tax that's paid for by the employer. So with that in mind, let's make some entries. So this is exercise 8-8, and this is on page 426. And we're going to make journal entries. So we need date, account titles, debit, credit. Okay, so let's see. Right, so here they're going to pay the salaries monthly, and January is the date, right? January 31st, and we're going to debit salaries expense. And salaries expense is the big amount, $3 million. Okay, now I guess it doesn't matter the order that you do it. I would just do it in the order they give it to me. So the first thing they give you is Social Security tax. Right, Social Security tax. Oh wait, that's not the order they gave it to me, but I'll do it anyway now. Well, no, that's it. $229,500. Federal income tax payable. Federal income taxes of $450. State income tax payable. State income taxes are $187,500. Okay. Now, what about the health insurance? The health insurance was $30,000, right? And these are all the amounts. I credited accounts payable for that. These are all amounts that come out of the employee's paycheck, right? BCBS, Blue Cross Blue Shield. And then salaries payable, the balance. So in other words, how much do we need to credit salaries payable for to make the journal entry balance? I have $3 million in debits, right? And subtract all the credits. I'm coming out 2,103,000. 2,103,000. Now let me just check that. If I add that up, it should come out to 3 million, which it does. Okay, great. Okay. So the math, my math is right. So that's the first entry. These are the employees' paychecks, right? So on a gross of 3 million, the take-home pay is going to be 2,103,000. These are all the amounts that are being taken out. And then eventually what we're going to do is we're going to debit salaries payable and credit cash for that 2,103,000 and pay everybody. So that's the first entry, right? That was the record employee salaries expense, withholdings, and salaries payable. The second entry is for the fringe benefits. So we debit salaries expense for the fringe benefits, right? Okay, now what are the fringe benefits that the employer is paying? The employer is paying, according to what the problem said, is paying for $90,000 for the health insurance. Remember the illustration in the textbook, there was health insurance and there was also retirement plan contributions. You would do the same thing. You would debit salaries expense for the total of the health insurance and the retirement plan contributions, and 2 credits to accounts payable, one for the health insurance, one for the retirement plan, 2 separate liabilities. And then the third entry is for the payroll tax. Right, and here I'm going to say to balance, right? Because you don't know this number when you start. This number is made up of 2 numbers, at least 2, sometimes 3. It's made up of the Social Security tax, right? Now, how much Social Security tax came out of the paychecks? $229,500. See why the boss is always so unhappy? Right? The boss has to pay an extra $229,000 for the employee's Social Security. And what about the unemployment tax? $186,000 for federal and state unemployment tax. Unemployment $186,000. So what's the debit to payroll tax expense? I have to add these two numbers together. Right, it comes out to $415,500. Right, so here's the whole problem. Here's what the whole thing looks like. Okay. Now, since we have some time, let's do another one. So let's look in the book. We have problem exercise 7, which is similar to what we just did. Let's see if that's one that's worth doing. Let's see if there's another one. Okay, I got one. This one's very similar to the example that's in the textbook. Right, this is problem 8-3B. I don't think we've done any Bs. But this one is very similar to the illustration that we saw in the textbook. That's why I picked it out. So Kashi Sales. Have you ever bought Kashi's cereal? It's pretty good, actually. Tastes pretty good. It's probably no good for you, like most cereal is. Kashi produces healthy whole grain foods such as breakfast cereals, frozen dinners, and granola bars. Assumed payroll for the month of January was $500,000, and the following withholdings, fringe benefits, and payroll taxes apply. So federal and state income tax, $135, health insurance and retirement plan paid for by the employer, and the Social Security tax rate, 7.65%, the federal unemployment tax rate, federal and state, 6.2%. Assume that Kashi has paid none of the withholdings or payroll taxes by the end of January, so record them as payables, and no employee's cumulative wages exceed the relevant wage basis. Yes, that's one thing I didn't really get into with you, that once your salary hits a certain level, the Social Security stops. But that level's pretty high. I think now it's around $130,000 or so. So once your salary hits $130,000, you stop having the Social Security tax taken out of your pay, but the Medicare tax is payable on every penny of salary you make. Even if you made $10 million, you'd still be paying the Medicare tax. The unemployment taxes stop depending on the state. I think New York State now is around $15,000, I think. So once you hit $15,000 of salary for a person, the employer doesn't have to contribute anymore to the unemployment tax. I think it's $7,000 for federal unemployment tax. So you see how it gets a little complicated, but here they're telling you don't worry about that. So 3 entries: employee salaries, withholdings and salaries payable, fringe benefits, payroll taxes. Okay, now I'm going to pause. Okay, so we're back now and we're going to take a look at answering the problem. And just to look at it again, on page 833 or 433, Kashi produces healthy foods, right? Assume payroll for the month of January was 500,000. So these entries are going to be made on January 31st. And there's 3 entries we're going to make. The employee entry, which is the gross pay minus the withholdings. The second entry for the fringe benefits. And the third entry for the payroll taxes. So the first entry debit to salaries expense, credit Social Security tax payable, and we had to calculate that. Oh, that was times 0.0765. Credit income tax payable. And that was it. So debit salaries expense for the gross, credit Social Security tax payable. We had to calculate that number. And income tax payable, they gave us that number. And now salaries payable, which is the number that we need to balance the entry. And salaries payable represents the take-home pay. Fringe benefits. Now, there were 2 fringe benefits here: health insurance and retirement plan. The total, if you add them together, right, was $73,000. Credit accounts payable for the health insurance. Credit accounts payable for the retirement plan. Okay, and now the payroll taxes. Now remember, the payroll tax is made up of the employee's share of the Social Security tax. We figured that out. We just used the same number that we used here. Also, the unemployment tax. So payroll tax expense to balance. We don't know what that number is yet. Right, the Social Security tax. Right. And how do we get the unemployment tax payable? Let me abbreviate so I can squeeze the calculation in here. It was 500,000 times 0.062. So how much is the payroll tax expense? We have to add the two together, right? Which comes out to 69,250. So that's the problem. That's the entire problem. First, make the entry for the employee's salary minus all the amounts that are taken out. Then the fringe benefits. Then the payroll tax expense. So if I were to ask you, what's the total cost of payroll for this company, right? 500,000 plus 73,000 plus 69,250, right? What's the total cost of the payroll? Right, it's 642,250. So how much are these employees really costing you altogether? They're costing you $642,000, not the $500,000 in salary, right? They're actually costing you much more than that. So these are things you have to consider when you're setting up your budgets and doing your planning and trying to figure out what you want to do in the coming year, that you have all these additional costs in addition to whatever salaries you have to pay your people. You know that it's going to cost you, in this case, considerably more than that, right? Let's see, how much more? A little over 28%. And that's a good rule of thumb that they say that the experts say that the extra costs between the fringes and the extra taxes, that 30% is not uncommon. So whatever your salaries are, add an additional 30%, and that should approximate what your total cost of your payroll is. Okay. So that's it for today. We're finished for today. Now, what I'd like to do is to come back next week and I just want to make sure that I hit everything that's on your exam. Let's take a look at your exam for a second. So the exam is due the 16th, right? The 16th. That's actually a week from today. So let's take a look at the exam real quick. So you've got a depreciation problem, straight line, declining balance, activity based. You only have to calculate it for 1 year. You've got a, in this case, it was a tractor that was purchased and sold 2 years later. What was there? Was there a gain or loss on the sale and how much? You don't have to, and here you have to make the entry for it. Right, and those two problems were from chapter 7. From chapter 8, here you've got the notes payable type problem that we saw today. Payroll, right? You got the 3 entries. Right, now keep in mind here, look at this, I can see that this is like the problem we had for homework, right? Where the employee pays some of the health insurance and then the employer pays the rest. That was like the problem we had for homework. Okay, and sales tax. Now, we didn't get to sales tax today, but I will do it with you next week. So, you'll see what it's like. It's not very difficult. If you go back to the book. Okay, sales tax. You bought lunch for $15 plus 10% sales tax. How much did you pay for the lunch? You paid $16.50 for the lunch, right? You paid $15 for the lunch plus $1.50 for the sales tax. The total was $16.50. Now, we're looking at this from the point of view of the store. In this case, the place you bought lunch. Right? So the lunch cost $15. That's sales revenue. The taxes on that were $1.50, debit cash for the total. Right? That's all there is to it. Right? No more complicated than that. All right. So that's it for today. I'll see you next week. We'll go over the sales tax just so I'm comfortable that you know what to do. And then we'll take another look at the exam, and then we're finished.